drawdown, which many traders really don't understand. Actually, you can apply this to any investment. We will check this and we basically calculated what is the tipping point, or what is the point where you cannot return again, where you lost so much money that the chances are, the odds are against you and you will not make it back. Okay, the idea of the FX method, which is actually our brand in the UK, is that you should do the things differently. If you have been trading in a specific way, whether it's manual or automated trading, and you are not successful yet, chances are you really need to think it over again. And we just invite you to check into our approach. We trade with automated trading, but many of the things are applicable to manual trading. Okay, first of all, I'm going to explain what is a drawdown. Many people already know that, but I think definitions are important. So I'm going to get into this definition quite in detail, and then later we'll really talk about the exponential function and more in detail what the recovery function is and how you can calculate it basically. And then we'll have a small recap, and I hope it helps you really to control your risks better on your accounts. Okay, so drawdown is basically defined as a dip in the capital curve of your account. Question is, from where to where do you measure it? Okay, I can show you drawings the next slide, and you have here the capital curve, and this is what we call the watermark. I'm going to try to find the pencil here. Some color, some interesting color, maybe red actually. So that's the watermark, or let's blue. This is the watermark. Okay, and from this last watermark, that's the highest high in the capital curve, or in the balance curve. They're called the same way. Actually, we use balance curve in MetaTrader. It's drawn in blue in MetaTrader. To the lowest dip, we have here what we call the maximum drawdown. In this case, we could have many other drawdowns, and then we would call the maximum drawdown or maximum drawdown the biggest one of all of those. But in order to define that, we must be clear to what we refer this actually. And that's not so simple, because some people use the drawdown referred to the actual capital. Let's imagine, or let's suppose you would be starting with a 10 grand account. Let's make here just a little bit of paint. I'm going to draw a little bit. I usually draw very badly, but people don't understand the explanations. So you start with 10 grand here, and you happily manage to get 50 grand, and the drawdown starts here. And let's say you make a drawdown here of 1,500 quid, right? Which, whatever, the account could be denominated in dollars, in pounds, in euros, and everything. So many people would say that this is a 10% drawdown, because they refer it to the balance of the moment, what I call the actual balance. And I think that's a wrong philosophy. You should really refer it to the worst of both capitals, which in this case I call the initial balance. Because let's imagine you're doing a back test and you have this drawdown, and this 1500 happens, you start trading here, and it happens here, it's a 50%. You see that? So the first thing about drawdown is, to what do I refer it? Do I refer it with which figure? The actual balance, or the initial balance, or the worst of both? And I would say you should always take the worst of both figures to calculate the percentage, what kind of drawdown you have. That's the first thing about defining drawdown. Then the other thing is that if we have several drawdowns, I would just take the highest in value. I don't care how the capital grew. Let's imagine you would be already here back, everything went well, and you went back and you managed to make 20 grand, and you have here a drawdown of 2,000. I would take this one actually to calculate, right? Even though if you refer them to the actual balance both are 10%, this 1500 and this 2,000 are actually 10% to the actual balance, I would take always the biggest drawdown in value, in absolute value, and refer it always to the initial balance. I know this is a very strict definition, but it helps me a lot to calculate risk in a very conservative way. Okay, so that's the third point here. We always calculate it in absolute value. Okay, and that's very important, because the drawdown can happen today. You may say, well, that's actually very unlucky. Yeah, it's very unlucky, but when you're trading, all the unlucky things happen together. Like we call them black swans, based on a book by Nassim Taleb. He's a very brilliant mathematician. And the black swans, these these terrible situations that happen in statistics and in life and in economics and you name it, they always happen today when you really want them. So it's better you calculate them this way. So besides that, there are different definitions for drawdown, and I'm going to give you 3 of them. The first definition is the usual one, which is basically the largest dip in the balance curve from highest point to lowest point. But they only take into consideration the balance curve. There is, as you know, at least 2 curves. The first one is the balance curve. That means the capital you have when you close the trades, okay? And the other one is the equity curve. And that the difference between these two is what I call the floating. In your account, you could have like, this is the balance with closed trades, right? And you could have here a trade that floats against you, and you continue trading, you close trades here, and you were lucky, you close this one happily in earnings. And you could have a trade that floats in your favor, like the trend system, right? And that's the equity curve. In MetaTrader, it's very easy to recognize because we have in green the equity curve and the balance curve in blue, and so we know which one is which. But if we define drawdown as from the highest point to the lowest point, and we don't mention, if we are naming here, what is part of the definition, whether the balance curve or the equity curve, we're really not defining drawdown very well, right? So it's very, very important that you define which curve are you meaning. Usually we mean the balance curve, but if we take, for example, a very risky trading system such as a martingale, probably have heard about it, and you are trading a lot of lots, and usually martingales, the balance curve is like this, it's a perfect line, and the equity curve is doing something like this: 1 lot, 2 lots, doubles, 4 lots, 8 lots. You see that? It has this ugly equity, I don't know how to call it, equity areas. And you would say, okay, there is actually no drawdown here, but in reality, you should take also into consideration what is floating against you, and you may find suddenly you have a 30% of your capital floating against you. So I think that's a better definition, right? That you consider the beginning, the highest point, you measure the watermark on the balance curve on the blue line, right? And you measure the dip on the worst of both, meaning the worst of the blue line or the green one. That would consider risky systems like such as grid systems or martingales or crazy styles of trading like hedging and stuff. So that's the second definition, right? The largest dip in the equity curve from the highest point, sorry, I didn't write it well, from the highest point in the blue curve to the lowest point in the green curve. And the third definition is the one that MetaTrader is using. Many people don't know that actually, but MetaTrader uses a very unique definition for drawdown, especially for the maximum drawdown, and people don't know this. So what's the definition of MetaTrader is the following. They take the blue curve, MetaTrader, which is a capital, balance curve, sorry, the capital curve is the same actually, right? And from the highest point, let's say you went into a dip here, and imagine on the lowest dip you had 1 or 2 trades floating against you, but it's taken from the lowest point. So first of all, you need to take the lowest point in the balance curve, which is this one, right? And from there, check if you had any trades open that floated against you, and that would be actually the measurement of MetaTrader. That's drawdown for MetaTrader. Many people don't know that. We know that because we calculated the drawdown with our own software, and the figure was always different, and we were wondering how come it's always bigger in MetaTrader. It was just a little bit more because we trade only one systems which are simple with one trade per position, and we understood that there was very many times one trade floating against us. So we understood that MetaTrader defines it this way actually. So that's the third definition. I don't know if there are any questions before I continue. So we have a clear definition of what is drawdown. There's other definitions. I don't want to make it too complex. I think with these 3 we're quite covered. If there's any questions, please feel free to put them in the chat. And otherwise I will continue with the explanation. Okay, the problem with drawdown is that when you're going down, the fall is linear, right? And the drawdown recovery is exponential. And many people don't know that. And I'm going to take the best example, and which is my friend. I don't know if you can hear that. I'm going to put the loudspeakers, high volume. It's one of my favorite cartoons, actually. Hope you can hear that. So that's actually what happens with Drawdown. Let me explain it. The thing is that there is a tipping point. If you notice the coyote when he was falling down the cliff, first there was this typical sound of this when he was falling down, and then there was a point you didn't hear anything, and 1 second after you saw the dust, right? That's actually the tipping point. It seems that we are not so close to death, but we calculated, and I will explain you why, that when you lost already 23% of your account, you're very close to die, because the recovery is almost impossible. And you may say, well, that's not much. I've risked many times 50% of my account, or 35%, or I don't know, 60%. And I will explain you why that's actually sheer madness. The tipping point, the point where you don't hear the coyote anymore, till the point he dies, they're very close to each other. Even if you think, okay, I have still 70% of my capital to recover, the problem is the risk. And we will discuss now why we came to this figure, which is 23%. So basically what we did is what I call the drawdown recovery table. And actually, if you ask for this, I can send it to you, no problem. Just drop us an email at the end of the lecture, and we can send you this table so you have it. Actually, you should print it, because that's one of the most important tables that you will ever have as a trader. So when you lose 5% of your capital, you need 5.26% to recover. Why? Let's imagine you have a £100 account, right? £100 or dollars, doesn't matter. And you lose 5. The remaining capital is 95. That's the formula here, you see that? So 5 divided by 95 is 5.26. You may say, well, the difference is very little. Losing a 5%, recovering to the same point, coming back to the same point. Imagine the coyote could come back to the cliff. He sometimes does, actually. He comes back to the cliff. And it's only 0.26%. Okay, but when you lose 10%, that's already a bigger difference. That's 11.11% to recover, and you need 1.11% more to get back to the originary point, to the watermark. When you lose 20%, you need 25% to recover, which is a 5% difference. And there it goes. When you lose 50%, you need 100% to recover, right? That's a 50% difference. That's a lot. So what we did basically was we checked what is the average that I can expect on an average trading system. Not the best one, not the worst one. And I found out that an average trading system, whether manual or automated, it will make you $10 on average per trade on a $10,000 account. That's what I found out, right? We can discuss if we say, no, on average I need 2%. That's great, but you're not counting the losing trades. I'm counting everything. I'm counting what I call the expected payoff or mathematical expectancy. That means what I earn just entering the trade, independently whether it's a losing trade or an earning trade, the average, right? And on average, we are making $10. If we're making $10 on a $10,000 account, that's equivalent to a 0.1% earnings, right? That's a very conservative measure of what a trading system could do. We could change this here in the formula, and you will see still if we would be doing $20 on average, it would still be very difficult to recover from the lower figures. That means that when I lose 5% and I need 5.26%, I need 3 trades more. You see that? On average, to recover to the point I was. That means that going down doesn't cost the same as going up. Going down is maybe 7 trades, and going up needs to be 10 trades. Follow? When you lose 10%, you need 11 more trades to come to the original point. It's still doable, but you need to consider that these 11 trades are profitable trades. So it may need some more time. You need 11 more trades than the trades that brought you down. When you lose 20%, you'll need already 50 trades. You see where I'm heading? Beyond 2.5%, there's no way you're going to make 65 trades, more earning trades. If you had a very good trading system, you divide this by 2, and you still would need 32 trades, right, to recover from a drawdown of 23%, which is very difficult, 32 earning trades. Besides, it's not logical that the trading system that brought you into the dip will recover you. And that's basically what we have here in the slide, just a bit more clear in case you review the video. And so you see 5% is 3 trades, 10% is 11 trades, and 20% drawdown is 50 trades more. It's undoable. You need to be Superman. Suddenly the trading system, the trading style that brought you into the losses will make 50 trades more. Why? Because it makes no sense. The same trading system makes absolutely no sense. If you talk to me and you need to trading another trading system, we could be talking about it, but not the same one. So you see 20, 25%, 30% are really very bad figures already. Okay? So it makes no sense to think that the same system will bring you back. Okay? So you really need to ingrain into your brain this figure, 23%. It really helps a lot. Imagine it would be go further. Imagine we would just go further down and just lose 30% of our account. We would need 128 more trades. Even people that say, well, 40% is reasonable, it would need 267 more trades. And a 50% would need 500 more trades. Undoable. Completely undoable. What people do is they start overlotting. They go down and they increase the lot size times 2, times 3, times 4 to recover, which if they have a lucky trade, they'll recover, but if they don't, they lose the full account. That's the situation of Coyote. When he's really with the whole gravity law against him, falling down, how can you expect to recover down there? Chances are you will not, and you will hit the floor. Okay. So it's very, very important that you see this in the right perspective, because many people are very tolerant or with these figures, and they shouldn't. Okay. So in all this, actually, and that's why I call it a double exponential factor. In all of this, we didn't consider the money management. We were only considering that we lose 20% of my capital and I'm still using the same bet size or lot size. I don't care whether you do spread betting in the UK or you are using lots like we do in mainland Europe. The thing is, losing 20% makes no sense that you keep the same lot size. You should actually at least reduce your lot size also at 20%. Right? So when we said you needed 50 trades, you need actually more trades because you need to have these trades with less lots. You follow? So here are the figures. Here are the real figures. On the right column here, in red, you will understand that if we consider money management, the thing looks even more grim. When you lose 5%, it makes no difference. You need only 3 trades. Losing a 5% is nothing. It's really no problem. Also in institutional trading, not a problem. Even losing a 10% is doable. It's just only 12 trades more. But here you see 20%, you need 60 trades to give the same point. 32.5% are 80 trades. And when we get to losing 50%, as I need to reduce my lot size also 50%, I need to do 750 trades of $10 of the same average expected payout to get back to the same point. That's completely undoable. So that's what I call actually the double exponential nature of drawdown. You see why it's doubly exponential? First you go down into the dip and it costs you more money to go back. So actually what people don't understand, 1% down is not the same as 1% down. That's very, very important. 1% down depends completely on where you are. It's not the same losing 1% to 6%, sorry, 5% to 6%, than losing 20% to 21%. Every 1% down, the farther you are down the dip, the more costly it is, not only psychologically, but also in terms of money, of capital risk. Okay, so drawdown is not equal to drawdown, and a 1% is never equal to 1%. So the thing is, how much can we really expect to afford? And it depends completely on the trading style you are doing. If you're doing trend systems, usually trend systems make more money per trade. They take more money. That's one of the benefits. They have other disadvantages. Well, actually, they have disadvantages as well and other advantages. But one of the big advantages of trend trading, trend style trading, is that you are making more money on average per trade. So you could be expecting even up to $30 per trade in a $10,000 account, or 30 pounds per trade on each single trade on average. So you could divide all of these figures by 3. So what does it mean? Actually, I could be trading, if I divide this by 3, and I have a trend system which is quite good, making $30. You need to know the expectancy of your trend system, and divide this by 3, I get that 26 trades will get me back to the point. So I can afford that 23% on a trend system, which is strong. But I cannot afford it on a simple scalper, right? On a simple scalper, I should be stopping at, because it will make me only $10 per trade, a simple scalper, and that's the main point, that drawdown is not equal to drawdown. Depending on your trading style, the absolute maximum is 33%, independently of the trading system you have. That's something you really shouldn't ever cross, no matter how good the trading system is. I'm going to put it in red. That's really the limit, but you can afford this in a trend system, 23%, and you cannot afford it on a scalper. You should be stopping on a scalper or something in this surroundings. I would say something like 15% should be your limit in the drawdown you could afford on a scalping system. Benefit of the scalping system is you do many more trades, right? So you could recover quicker from a drawdown. So what you're not recovering, what you're not getting in depth in a scalper, you get in time. You're faster on recovery. But that's actually the figures I would recommend. On a scalper, 15%, on a trend system, at 23%. And I just gave you mathematical arguments. This is not something which is debatable. This is just pure figures, right? That's gravity law, as I call it. So that's very important that you keep these two figures in mind. I'm going to write it one more time here. That's for a trend system, we will afford 23%. I'll put it here red. Okay, or less. Okay, that's the maximum drawdown you will afford, right? Or less. And for a scalper, we will afford something like 50%. Because our expectancy, our expected payoff is only $10, $12, $13, $9 per trade. Okay, when you do a lot of back tests in automated trading, you wouldn't understand it, but you can as well analyze your manual trading accounts, check what you earn on average per trade. Especially if you had a lot of trades, like 100 trades, you can really calculate that, and you should know it. That's a very important figure that every trader should know about the trading style. Okay? So once you understood this, you understand that it depends on the trading style, right? A breakout system would be something in between, like a 70%, not more. But what should be very, very, very clear for everybody is that anything beyond 23% is complete suicide, because you will never recover from that point. So if you have questions, the moment is now. I'm going to put again here the drawdown recovery chart, and if you want it, no problem, you can send it over by email. And this is very, very important that you calculate it yourself. And this is what we call, actually, this column, the divergence, or the drawdown divergence, is how much, recovery divergence, how much more percentage do I need to come to the initial watermark, to come back actually, not to earn any money. Okay, I can actually draw it so it's a bit more clear. Let me try to find paint one more time here, and so we understand why it costs more. Okay, because many people have a problem with that, to understand why the recovery is more expensive than going down. So let's say, for example, you were earning very well, and you went here into whatever 50% drawdown, right? The thing is that you have two problems against you. One is you cannot have here the same lot size you had here, right? Let's say, for example, you have here one lot. Here, if you lost 20%, first problem is you need to lot 20% less, or less, actually, unless you're doing a marginal money management, and that's really not recommendable. And the other thing is that you're recovering by average hits, and the thing is that if you calculate it yourself, you will understand because you have less capital here, you have 80% of your initial capital, right? The recovery will cost you more in number of trades than the going down. I really want you to grasp the concept. It's a mathematical concept actually, and it's always X amount of trades, only to get to the same point, right? So drawdown is very expensive. And I actually apply it to everything. In real estate, for instance, or if some stock lost 25%, 53%, it's a very risky moment. I know some stocks recover, but that's for me gambling actually. If you're really trading beyond 23%, for instance, real estate, what happened with Pablo, right? Many people lost 20, 30% on the real estate. And I think that's also applicable to this type of investments, right? Unless you're doing it for security reasons, which is to be considered, right? But if it's really for investment reasons, you should take into account drawdown and the percentage I just mentioned. So, if there's any questions, feel free to write them here. I did it very, very fast today. Pretty much done. It was extremely fast. Is there any questions? Okay, if there's no questions, I'm going to invite you to a lecture we have this Saturday in London. I'm going to try to copy this. Actually, this. Yeah.
Pablo, if I can just interrupt for a second, I'm not sure that you're seeing the questions. But Wayne's asking, could you email the drawdown recovery?
Of course, yeah. This is our email. You can write us over here, and of course we can email it to all the people who are interested. We'll email the Excel file. Sure.
Okay. What I'll do is I will type in that.
Yes.
For the event that's happening this Saturday. So
yes. I can also
just
copy it here. I think I have it here in another format. Yeah. It's great. It's great if you could come over. It's going to be Kensington Close. It's a lovely hotel, and we're going to be talking about these issues. And it's going to be actually 12 hours long, free course. So I think it's really of interest. If you like what you heard today and you want really to get a deeper understanding of these figures and what automated trading is actually about, here's the event landing page. So you can get an idea actually of how it works. The morning will be more theoretical. You should come the whole day. It's from 8 till 19. We'll have a lunch break, of course. And it's a Saturday, okay, and it's very close to the tube. I don't remember what the tube station it was. High Street Kensington. So you can really come over and have a look. And there's not many tickets left, actually. Actually, Simon invited already many people from RTC. So this is the hotel. You can read a little bit and have an idea. And there is another course we are having on Tuesday, actually, which is a course in Taxi Trader's office. That's actually an FCA regulated broker in Cannon Street. And that's where we were going to deliver the course. It's a very beautiful office, but that's only in case you really want to become a client of XTrader, and we'll give you 2 free robots for free and a complete day of advanced education, everything for free once you become a client. So I can also put this here over in the chat so you have an idea. And meanwhile, ask me any questions because I'm not so sure the explanation was clear.
Okay, Dan's asking a good question, Pablo. He says, what do I do when we reach the 23 or the 15%? Do we write it off and start again, or stop trading? What do you say for that?
I say it's a very good question. I say it's actually a game over situation, or what they call actually in nuclear physics a super-GAU. That's like an event like, for example, Fukushima or Chernobyl. It's so bad, you really need to close your nuclear central. You need to close your account. That's what I do actually, and withdraw all the rest of the money because there was something wrong in your trading style. It doesn't mean I don't trade anymore. It means I don't trade that account anymore. And for me, it became a very good habit to close the full account, because otherwise, psychology will betray you. You see, you lost the 23%, and you will say, "Well, I'll make it back," and chances are, big chances are, you will never make it back. So it's better you have your 75% or whatever it is back. You withdraw it, you close that account, you learn, you continue the demo. I would say at least a couple of months. You change completely your trading style. Once you are secure, you find another account. But if you have this habit of closing the account at 25%, believe me, your trading will become much better over time. I mean, I've busted 5 trading accounts. I know what I'm talking about, right? Of course, there's already 4 years I haven't busted any trading accounts anymore, but I've been there. I mean, I lost on the 7th of May 2010 over 50,000 euros in a day. When the Greek crisis, the first Greek crisis was arising, I just said, okay, I'm Superman, I don't need the stop losses, right? And that's why I developed these rules, actually. This all came after. I said, well, it cannot be, I studied mathematics, and I don't deal with drawdown. So I needed to develop a system, or a method, better said, of dealing with risk. And the biggest figure in risk is maximum drawdown. That's really 23%. Yeah.
No, I was going to say, yes, you're right. There's no better teacher than Mr. Market, I think. That's what I'm saying. I think you've answered Leslie Ann's question as well. She was asking a similar question. So you've answered that.
It can be answered another way. There's many regulated traders in the city. There's many asset management people, asset managers, and usually you sign a power of attorney with them of 30%. So if the consensus is in the industry that 30% is very bad, that you should stop trading, that means that around 25–30% something is happening. Something is happening. There would be no professional trader that would continue trading 1 million beyond 30%. So I calculated more precisely, and I found out it's 23%. It's not 30. 30 is too far down. You see, there's a slight difference, but if you watch it carefully, from 23% is 65 trades, and 30% is 128 trades. It's double amount of trades. It seems like not much, only about 7% more, but you will never make it from 30%. So I should say 33% is a good figure to stop trading. Okay. I know many people here have been beyond that, including myself. But I think that's why you came here to this lecture. You stayed till 7 p.m. It's late, right? In the UK, and you are in the States, it's earlier. But you should really learn the lesson and try to do it. And if you're wrong, stop your training after 23% and tell me later how it went.
Okay, Wayne's just asking, how much of your trading account do you stake on any one trade? I hear anything from 1 to 5%.
It's below 1%. The question is very good, and we could actually have another webinar on that. And it's the risk per position. We call it the safety net number 1. What we're talking now is the safety net number 3 in our method, in the FX method, which is the maximum drawdown. And it's we need to distinguish there what is the maximum risk per trade. It should be less than 2%. And what's the average risk per trade? It should be less than 1%. If you're trading on average around 3%, you just calculate 3%, only with 8 trades, you would be losing 24%. And 8 trades against you are very easy to obtain, right? You would be closing your account every 2 months. And that's not feasible, right? So it should be less than 1% on average. That's what professional traders do. Actually, we're trading on a 0.5% on average. We're trading more institutional, right? I'll be talking about this tomorrow. I will be with Simon over here at 5:30. What are the benefits of automated trading? We will be talking about portfolios, one of the topics actually, over here with Simon. Please join tomorrow. We'll talk about this.
Sure. Time for one final question, Pablo. Well, 2 more. Why don't you use stop losses?
Sorry, I didn't hear the last part.
Do you use stop losses?
All the time. All the time.
Yeah.
All the time. We have like, I could say, let's draw this. I mean, actually, without stop losses, you cannot trade. Actually, you should have actually 2 ways of exiting the trade. One is what we call the full stop loss. Like, for example, you enter a trade here. Let's say it's a buy trade, right? And you have what we call the full stop loss, which should be always less than 2%. And on average, you should be exiting the trade here in the middle, which is less than 1%. You don't need to wait every time to your stop loss. You need to close earlier than that. That's the whole trick. On a maximal, the maximum is the stop loss, which is at 2%, right? And half of the times, if you close at break even, right, 50% of the trades you close at 0. Let's say, for example, this is a quick calculation. On average, you'll be closing at 1%. So it's very important to distinguish average losing trade from maximal losing trade. But there is no way we can trade without stop losses. Absolutely no way. All the time.
Finally, quite a good question just from Leslie Ann, just to finish with. Can you just summarize again the 3 definitions of drawdown?
Sure I can. Let me take the slides one more time, and let's go backwards. I know I was really fast, sorry for that. I usually take more time. Simon knows that. I like to, yeah, but today I was in a rush, I don't know why.
Not a problem, not a problem.
Probably because we have the airplane tonight. Okay, so the thing is that we can calculate drawdown in different ways, and the usual calculation is based just only on the balance curve. That's definition number 1. From the highest point, or what we call the high water mark, in English high W, that's the professional name for this actually, or the watermark or high watermark, meaning that high watermark means that I will not earn if I don't reach this point again. Okay, if I'm, like, for example, an asset manager and I'm trading your capital, what matters is the last watermark, right? Okay, so the first definition of drawdown is just only on the blue curve, right? Meaning on closed trades, right? But imagine I would have here some ugly or nasty floating trades against me. Then let me draw it so it's more clear. That here is definition number 1. Okay. That here is definition number 2. From the highest point to the lowest point, whether equity curve or balance curve. That's definition number 2. And I could have a third definition which is very precise, which is, for example, I didn't draw it well for the third definition, but let's imagine in MetaTrader, I'm going to draw it one more time. I have here in this point, all in this point, I calculate how much floating I had in this point, in this very point against me. If I had floating in favor, I would take the blue line. That would be the definition. But if I had some trades that were against me, MetaTrader will tell you this is your drawdown in this very point. And that's definition number 3. And that's the one we're using in general, right? Because we generally don't trade these nasty systems that have so much floating, so many trades open against you, right? Because actually you could have a trading system that actually on the balance curve has very little drawdown, which is very nice, but has a lot of trades which are open against you, and maybe here you have already 20%. So you're very close already to 23%, and that's actually a very crazy trading style. You see that? So I would say take either definition number 2 or take definition number 3, the one from MetaTrader. Actually, MetaTrader will calculate it for you. If you have a MetaTrader account, which actually the platform is for free, you can trade on demo on MetaTrader, it will give you definition number 3. And I'm going to put the slide now. The second definition is wrongly written in the slide, sorry for that. From highest balance curve point to lowest equity curve point. It's missing here. Okay, maybe we should add it. And I hope it was more clear now. From highest balance curve columns to the lowest equity point. So we have the second definition properly. First missing. That's the equity, right? Okay. That's the second definition. What matters is you really need to consider the open trades. Because if you don't consider them, you're really lying to yourself. You just watch the balance curve and you say, oh great, I only have 3%, I only have 5%. And you are letting trades float 35% against you. What would happen if the situation like this bank on the 15th of January or some really bad situation would happen on the day like it happened to me? Right? Like Simon says, the market is the best teacher. Right? So you should consider all the open trades always when calculating drawdown. Otherwise, you're lying to yourself. Or somebody's lying to you. Some people are really, I wouldn't call them scammers, but some people show you account results without showing you the equity curve. When a trader shows you a statement, you need to watch always into the equity line. How many trades were floated against him or her? That's very, very important. Because that's the truth of the pudding. That's the proof of how good this trader is.
Huge thanks, says Leslie. Makes more sense when I'm here seen on the same doodle. So so that's that answer, which is good. Once in profit, Pablo, do you bring your stop loss to break even?
Oh yeah, definitely. If it's a trend system, yeah, we will do it automatically. Actually, it will move the break even by itself. And actually, the second system we give out with the course with AxiTrader has it already incorporated. Actually, I'm going to have your platform, and it's already installed. I didn't prepare it, but I could show you how the robot moves to break even. It's really beautiful. It does it by itself. I don't know if I can show. We have a minute. Let me erase this ugly green color here. So I don't know if I installed it by chance. I did prepare it, but I did find here some trade. Yeah, it's installed. And okay, I have a very tight stop loss here. $10,000 account. Yeah, I can try to find a trade here, which looks nice. And I'm going to show you here on the chart how the robot. And I give this out for free. Okay, that's the balance curve, you see that? And it's very, very close. If you looked into it, let's make a very small back test. One more time, I want to show you both curves in MetaTrader, how they look. I don't know if you see here, if you appreciate here the green curve. Here. So that's actually the way we trade. We trade very close. We have some trades that float a little bit against us. Maybe I will make it shorter, maybe take this 1 month. test so people can see that. And now I'm going to show you how we can use the stop loss to break even Robot by itself. We don't do that. Actually, we let robots work for us. You see the green curve now? That's the equity curve. Trade number 6, the trade was open in our favor. You see, and on trade number 3, the trade was floating a little bit against us. I'm going to look for this trade now. I'm going to show you 4th of January 2005. So not test. I'm going to show you up here how the bot is moving to break even and beyond. Let's see if it's not too fast. I don't know if you can see the flat chart there. Always I can click wide for a minute. Okay, just by testing, I'm going to put it wide. I didn't prepare this, so it's all. It's actually one of the beautiful bots. Okay, so that's actually what would have happened with this trading system on the 4th of January 2005. In a very long back test, I could take also some trade in 2016 actually. But I just wanted to show you the trade. The trade on the 5th of January. These are 5-minute bars, right? And with this I can move the speed and the trade comes into the market sooner or later. So one more day to go. Oh, there it went. You see, there is a stop loss. Okay, and if we are lucky, it's moving already in our favor. The trade stop loss is still not moved, and sooner or later it will start to move the stop loss by itself. There it went. So it takes a little bit of time. And the good thing is that it doesn't move to break even immediately. Many manual traders, when they are in earnings, it takes in our robot, it has some formulas inside. You saw it. Now we are already in the earnings. I don't know if you appreciate that. Well, that we are on a sell trade, the stop loss already a little bit beyond break even, right? And it will start moving the stop loss, you see? Securing earnings, but letting the trade stay alive. That's one of the problems of manual traders, right? That would be actually a very earning trade, I think, over 100 pips or whatever. And the bot considers, you see, it only moved it much, much later. So, put it here. It made a very long trade, you see? Trade, and it took all of this trend beautifully, and it moved here from the 4th of January till the 7th of January. It was 3 days open, and it moved the stop loss not one single time, and it made a 7% earning in one trade. It doesn't happen every time, but you see it moved the stop loss at 14.20, 14.25, and it moves the stop loss sometimes 10 pips, sometimes 4 pips. But it moved it 6 times to make a 7% earn. With very little risk. It has the stop loss very close, like 50 pips on it. And sometimes it makes 200 pips. So that's an example of a break-even robot, right? I don't know if you could see that well enough on your screens. If not, we will upload the video and we will appreciate it better. So is there any more questions?
I think we've covered everything, Pablo. No more questions tonight. I think you've done extremely well. Thank you. I think we do, and it's my fault. I think we've got a fairly tired audience, and we've had a big day. And I can see a lot of the names of people here being with me for the day, which is good. So appreciation to you for coming on and giving us. I know tomorrow you're on a little bit earlier, at 5:30 for the second presentation on automated trading. So we'll look forward to that tomorrow. But I think for the meantime we'll let you go. I know that you're flying into the UK tonight. I hope it's not too windy a flight, because I know there's some strong winds.
There is.
Yes. I'll think of you. And well, if you don't turn up tomorrow night,
you know the reason already. Okay. That's great.
Pablo Ortiz from the FX Method. Always a pleasure having you on. Thank you for spending the time with us. We'll let you go now, and I'll take the presentation roll back, and we'll look forward to hearing from you again tomorrow.
Perfect, Simon. Thanks very much once again, and I hope to meet you tomorrow at 5:30. Bye-bye.
Yeah, you will, don't worry, there's no doubt about it.
There's not, yeah, okay. It will be from London, actually.
Don't worry.
Okay. Thanks.
Done.